Hi, this is Luke Gromen from FFTT. Hope you are well. I'm going to jump right into our biweekly Q&A. I really appreciate everyone that submitted questions. I'm going to run through a few of them here and then get ready to watch tonight's national championship game, which I think is going to be a really good one. So, from the first question, Jim, is it possible for global asset prices to decline while global liquidity is growing? China has the pedal to the metal, and the Timmerhouse article this weekend in the Wall Street Journal makes it look like the Fed is heading that way too. And the Timmerhouse article, by way of context, was noting that I believe it was Lori Logan, head of the Dallas Fed, former head of the New York Fed trading desk, saying that they may need to slow the pace of QT. And so, in short, in my opinion, no, it's not possible for global asset prices to decline while dollar liquidity is rising. Global liquidity is rising. So I think you could see, to me, it's a question of relative sensitivity. And I think we're seeing Bitcoin's doing really well. I've continued to call that the last functioning smoke detector of liquidity, and it's functioning, and it's telling us liquidity cometh. So next question is from TJ. Could you please explain why the dollar rallies when Saudi Arabia sells oil to China in renminbi instead of dollars? It just seems like there's less dollar demand from the Saudis when oil that was previously bought in dollars is now bought in renminbi. It comes down to the context in which that modest diversion of oil volumes away from the dollar toward renminbi would occur. And what I mean by that is there's a large persistent bid for dollars out there by virtue of how much offshore dollar denominated debt there is, the Eurodollar system. And so you have big dollar demand all the time. If you have a shift, even a marginal shift of oil volumes out of dollars into renminbi, you're going to constrict new dollar volumes into that very strong dollar bid. New dollar supply will be constricted into that very strong dollar bid by even just a little bit on the margin, but prices are set on the margin. So a little bit lower dollar supply, very strong dollar demand means dollar up. The flip side of the same coin is that you would be increasing renminbi volumes when you shift just a little bit of oil from dollar to renminbi into a world where there's just not a lot of incipient renminbi demand. There's not a lot of offshore renminbi debt. There's no euro renminbi system like there is a Eurodollar system. So a little bit more supply of renminbi, not a lot of renminbi demand there, weaker renminbi. So technically in the short, it's a technical dynamic, mechanical dynamic. It's short and even into the intermediate term in terms of what that drives. And it's only dollar versus renminbi. As we're seeing, it's good for gold versus the dollar, as gold serves as a neutral reserve asset. We're seeing central banks adding gold in place of treasuries and have been seeing that for the past 10 years and in spades in the last 2-3 years. Long term, it is negative for the dollar because it is negative for treasury demand. You don't reserve in treasuries as much at the central bank level when you're pricing oil more and more outside the dollars. We can see this has happened. This isn't speculative. Ultimately, in the short run, to the extent central banks don't buy as many treasuries, actually, again, good for the dollar. More treasuries offered, not as much demand, rates up, that drives the dollar up until the dollar gets too strong, and then foreigners have to sell treasuries to raise dollars, to service dollar denominated debt, and that continues until you have treasury market dysfunction, in which case the Fed's got to print more to buy those treasuries one way or another. And so it is ultimately bullish for the Fed's balance sheet. And so the process has been managed, I would say, fairly well. Obviously, the Fed's balance sheet has receded off its highs. But if you would have said to somebody 10 years ago, the Fed's balance sheet is going to be 10 times the size it was at the peak after the great financial crisis 10 years from today, they probably wouldn't have believed you. But here we are. So that is really, non-dollar oil is bullish for the size of the Fed balance sheet. And that is, I think, the key why it's ultimately, I think, negative for the dollar in the long run. From P, will we get back into a deflationary environment vis-a-vis Lacey Hunt, or are long rates headed above 5%? The U.S. government cannot afford deflation, and the U.S. government cannot afford long rates over 5, as we just saw, based on how the Treasury market, long U.S. Treasury bonds crashed in the third quarter of last year. They were down nearly 20% on TLT, for example. Since the U.S. government cannot afford deflation and they cannot afford more rates above 5% at the long end, tells us, in my view, that we'll have neither, at least over time. I think we're going to have secular inflation with secularly negative real interest rates at the long end. Long U.S. Treasury bond portfolios, like Hunt's, have done very well pretty much no matter what for the past 40 years. It's been a case where generally, up until at least 2021, owning long U.S. Treasury bonds was a one-way trade. They always went up, basically no matter what. In my view, now long-term Treasury bond portfolios will lose on either a real basis after inflation or on a nominal basis pretty much no matter what for a time, because that's what the U.S. fiscal situation demands. The U.S. is in fiscal dominance. Long-term bonds need to lose on a real basis over a sustained period of time. Many investors have forgotten that real rates on bonds averaged negative 1% from 1901 to 1981 per the FT last year. There was a great article about that. So losing 1% a year on bonds on a real basis for 80 years has been forgotten because you made money every year on average on bonds on a real basis for the last 40 years. And almost everybody still thinks the last 40 years were normal and have sort of blocked out what happened the 80 years prior. I think they have begun to be reminded of that, and I think they will continue to be reminded of that on average over the next decade. I don't think long bonds are going to do very well at all relative to inflation for a simple reason. The most powerful government in the world, the United States, cannot afford positive real rates for any sustained period of time until they get the GDP lower, and that will allow them to be able to sustain their deficits a little bit better once debt to GDP is lower after a sustained period of negative real interest rates. From BB&D, what do you think about the argument that holding Bitcoin via MicroStrategy is better than holding it via ETFs, since it's likely to continue to outperform spot ETFs due to its carefully levered position in Bitcoin? I don't have a strong opinion on either way, MicroStrategy versus the ETFs. I understand the argument. I just don't know one way or another. The one thing I will say about it is something I would say about gold relative to gold ETFs as well, which is to say, if you want to own Bitcoin, own Bitcoin. Buy it, self-custody it. That removes all your risk other than the price action of Bitcoin. There's no exchange risk. There's no executional risk if it's managed, custodied, levered. However, there's the second you sort of have some sort of agency risk introduced, regardless of what that agency risk is. For me, if you want to own Bitcoin, own Bitcoin. So that's what I would say about it. From WW, Felix Zuloff said in a recent interview that there are legal limits on the percentage of short-term debt that the U.S. Treasury can hold relative to long-term debt. I think you mean issue relative to long-term debt. Have you heard about this, and how would you expect Yellen to handle the issue? I was not aware of it. If, to the extent, I have no reason to assume that Felix Zuloff doesn't know what he's talking about, and I'm sure he does. And so I would say that, in my view, any such legal restrictions like that would be mere speed bumps at some point for a quarter, maybe 2 quarters at most. And the reason I say that is because of something Jeff Gundlach pointed out in a speech recently that you can find online. It's public on YouTube at Grant's 40th anniversary conference. And he had an interesting point where he pointed out that it was illegal to change the terms of mortgage-backed securities in 2008. And you know what? When push came to shove, they changed the terms. They changed the rules. He also pointed out that it was illegal for the Fed to buy corporate credit in 2020. Push comes to shove. In 2020, they bought corporate bonds. They changed the rules. My point here is probably pretty obvious now, which is maybe that rule's there, and that's why I think at worst it'll be a speed bump. If they need to do it, they will change the rules. Illegal, legal doesn't matter, in my view. And then the final question from RN, what do you make of Doomberg's recent opinion that peak cheap oil is a myth and that we have officially shifted from a deficit era to an abundance era? Do you agree? And if so, does that change your thesis long term? First off, I will say I love Doomberg's work. I think he is very bright, and I think it is very well researched. I disagree with. Let me back up. I don't think our viewpoints are all that different on that. On it, I think it's more semantical than a wholesale disagreement. If you've listened to me talk about peak cheap oil over the years, I've repeatedly said it's not peak oil. It's not we're running out of oil. It's that we've run out of the cheap oil. It's that we need more expensive oil to continue to grow supplies to offset the decline rates of high decline rate shale and to grow and offset decline rates on the existing installed base of conventional oil. Doomberg's piece notes that some of it there is obviously, I think he raises a very good point about natural gas liquids, which is like a straight line 45-degree angle. And the fact that it is a byproduct to natural gas means it's very, very cheap. And to the extent that then gets substituted in elsewhere, it definitely helps on the supply side. And to the extent natural gas is continuing to be drilled for, that should continue to grow. Totally agree with that. To me, there is still very much a price sensitivity in the Permian and in the rest of shale that supports the ongoing peak cheap oil theory or the peak cheap oil thesis, which is to say the Permian is over half of U.S. production and productivity is rolling over sharply within the Permian. So I think it is an interesting point that he makes about the natural gas liquids. And I think, he also highlighted that, look, some of it is dollars priced or oil priced in dollars, where if the price of the dollar weakens, price of oil will rise. But that's not a peak cheap oil. That's a dollar problem. Yes and no, in my view. Ultimately, multi-currency energy pricing, which we've been talking about for a long time as well, ultimately means the dollar should weaken against oil, because now oil starts to become the pivot point. If you've got some oil priced in yuan, some oil priced in dollars, you should get some weaker dollar against oil, perhaps. Let me amend that, because I just said that in the short run, cheaper or shifting oil to yuan will make the dollar go up. The dollar can be managed through oil. If we want a weaker dollar and oil's priced in both dollars and yuan, there are ways that policymakers would be able to weaken the dollar through the oil pivot, aside of what the mechanical impacts of a stronger, that should drive a stronger dollar, all else equal, if left alone to market forces. So oil can be used to weaken the dollar, which then drives the dollar price of oil up. In theory, when you can use oil to weaken the dollar. So I want to make sure I'm clear that I'm not saying two different things literally 5 minutes apart. He also noted in his piece that oil is getting cheaper in gold, and I agree 100% on that, and I think that's going to continue to happen. It really started when Russia stopped buying treasuries and has been buying gold. Basically, as soon as Russia began buying gold with oil, that's just the world's second biggest oil exporter, bidding for gold with its oil effectively a few steps removed. The gold to oil ratio has risen markedly. We've gone from 8 barrels per ounce to 24, 26 barrels per ounce over the last 10, 15 years. So really since 2014. So over the last 10 years, gold to oil, the price of gold in oil terms has risen tremendously. It just hasn't risen that much in dollar terms. So it speaks to Doomberg's point that it's a dollar issue. Ultimately, the Chinese need cheap oil. The Americans need relatively expensive oil. And you can do that by strengthening the yuan versus the dollar a bit. That weakens the dollar, keeps oil higher relatively in dollars than in yuan. So there's some levers there. The bottom line to it is the base of U.S. oil production, particularly as the over half of it that's in the Permian. There's a baseline there. There's a sensitivity there that the peak cheap oil, in my view, is absolutely still a factor. Whether you look at the decline rates, the declining productivity in the Permian, or the fact that the other three big basins still have not retaken prior production highs, so which speaks to peak cheap oil as well. So with that, I'm going to sign off for the night. As always, if you like these updates, check out FFTT-LLC.com for more information about our tree rings product, 10 most interesting things, brief synopsis of what grabbed our attention about them, whether they support or refute a way we'd previously been thinking about the world. And as always, thank you for joining me. Really appreciate it. Look forward to talking with you soon. Take care, everyone.